Hey, good morning, everybody. Got the volume on now, and I'm looking forward to sharing this great session with you. Again, I'm going to keep it really short. It's going to be one topic, one idea, sticking to that theme. We're going to be talking today about how do I know I have enough money? Now, not so much
Good morning.
how do I know I have enough money to retire? Just simply, how do I know I'm saving enough? This is a really interesting comments that I got from the last session that we went through. If you may recall, last session I was talking really about, making sure that you have enough money to retire, answering that one burning question that everybody has: will I have enough money to retire? And so I did get some questions offline, and that is, how do I know I'm saving enough? What can I do to sort of track, if you will? Is there tools that I can use to track, am I saving enough? And I'm going to walk you through a couple ideas so you can understand, am I saving enough? And if you're not saving enough, what you can do about it. Now, I'm not going to talk to you about how to create more income or how to have passive income. Those are all different kinds of subjects I'm not going to go into, but I'm going to share with you a really simple idea of what to do. Now, one of the things I'm going to just say is I want to give you an update on the markets, because talking with some people over the weekend, and they're asking, what do I do about the markets right now? What's going on? I'm feeling kind of uneasy. And I would tell you this, and that is, look at this. This is the Toronto stock market. I'm not going to show you all the indices across North America. I just want to show you, just keep in mind sort of an idea. This is the Toronto stock market. You're looking at what, since 2017, this is what the market has produced. And so that big deep dive that you see there, that sort of V that you see around 2019, that's the COVID effect. That's what happened to COVID. So if you look at the value at the far left-hand side of the page, this is your 2017. What do you notice here? You notice that the markets were, let's call it 15,000, okay? And on the right-hand side, we see that this is yesterday. We closed, or actually, I think this is this morning, actually, 17,318. So the markets have obviously run up. And in that period of time, you've seen some really jagged edges, like if you look at a saw, the teeth on a saw, it looks like that. And that's not unusual to have the way equity markets run. So what I want you to see is the very far right-hand corner beneath my letter A there is, you see the market going down. And people are getting excited. They're thinking all these returns that you've had over the year, they're being erased. I don't want you to get all excited. Look at the returns. Look at the way the market has reacted throughout the year. You've got these small downturns followed by an upturn. This is normal rotation of the market. And especially right now, there's an old saying to sell in May and return later on in the fall, September. This is an old, I don't want you to get into this. This is this, if you're following in financial markets, they're going to say things like sell in May, go away. And this is really about professional traders. This is not the average person putting money away every month. This is not what you do. There is something you could be doing, and that is just rebalancing your portfolio. So as as different asset classes in your portfolio have gone up in value, you want to maybe take a little bit out of one and put it into the other. This is just rebalancing your portfolio. It should be done at least once a year. It's usually done at the beginning of the year. I usually do all of mine in January. But if you've got something that has just gone up in a crazy way, it's not a bad idea to take some of the profit and just rebalance it across your portfolio. So that's a normal thing. What you hear about on the news are professional traders who are examining how much leverage they've got in the market, and is it worthwhile to pay the extra cost to have leverage, to have this money sitting in their portfolio over the summertime, especially when they want to be away from the market and enjoy the summer. They don't want to have borrowed money in that period of time if something should go wrong. I would say to you this, and that is, just look at this market. if you look at back in 2017 in the spring, and you can do this yourself, and then go forward, you see that markets run up over the summer. And I would say to you this, with everybody being vaccinated right now, well, not everyone, but I mean, with 2 million vaccines that have been introduced for us to get to everyone in Ontario vaccinated, people are going to want to get out and spend their money. And so I would say to you, I expect the economy to do well over the summer. So you want to participate that in your portfolio. The next thing you want to do is you want to make sure you have a written financial plan. I keep banging this over your head because it's so darn important. A written financial plan. This is my financial dashboard that I give to every client. And so it's important that you track everything that you're doing to make sure you're on track. That bottom left-hand corner talks about what is the retirement income that I will expect from my portfolio. And so we track that to make sure that we're showing how are we increasing that over a period of time. So you have to get a written financial plan. So what are the things that go into understanding, are you saving enough? Let's dig into that right now. Time. When are you going to retire, or when do you need the money? For how long are you going to need the money? You want to get these down. It's very important. You get it wrong, you don't have money when you actually need it. Savings rate. Well, are you saving $4,000 a year, $5,000 a year, $25,000 a year? What is the amount that you're saving? And what rate of return are you actually getting in your portfolio? Now, this, I want you to understand that this is a very important thing. People right now are looking at their portfolios and saying, I'm getting 10%, I'm getting 25%. And so they're lulled into this false sense of security. Oh, I'm doing really well. And you forget that this is a long play. You're trying to save money that isn't going to be just 65 years of age. You need 25 years in retirement. So you're still saving. Your portfolio still needs to make money at retirement. It's not save up to 65 and then don't save anymore. Your portfolio actually needs to continue to make money. If it doesn't, you're going to run out of money unless you've got a lot of money saved, and that's a different thing. But most people need to make sure that their portfolios are continuing to make money as they're in retirement. So what is your rate of return? You need to know that. What is your risk tolerance? So risk tolerance is really talking about this here. When you look at risk tolerance, if you've ever gone and opened an account anywhere, one of the requirements is that we have to understand what is your risk tolerance. This is actually a law in Ontario. It's probably a law. I know it is a law across Canada, but the idea is it's a good thing for you to do. You want to take, answer some questions of each particular account. So your RSP account, your tax-free savings account, your non-registered account, whatever accounts you open up, each account has its own risk tolerance, because each of those accounts have different timelines. You know, some people, they'll put money away for, I love this, when I talk to some families and say, this is an account that we have only for vacation. This is an account that we have only for our kids' education. This is an account that we have that we're going to use for retirement. So they have, and they name them all these clever names, which is really nice. And all those have different timelines. They all have different saving strategies and different amounts that are going in. So, and risk tolerances. So it's important that you make sure you get this. So you notice in the bottom left-hand corner, the conservative profile has, I won't focus on the green and the gray, okay? So 80% is fixed income, bonds, GICs, cash. These things are relatively safe, provide a low rate of return, but fairly predictable in terms of rates of return. And you'll notice as you move up to the right, those green areas and gray areas change in percentages. So the green area continues to get larger. That means you're taking on more risk and the opportunity of making more money. That's what risk profiles really mean. And sorry to go into a longer explanation, but I want to make sure everybody understands what that is. Okay, back to this. So taxes, how much money are you making right now? And what taxes are you paying on that? So it's really important that you find an accountant and a financial advisor that are going to work in combination to make sure you pay the least amount of taxes so you can grow your investments. And expenses at retirement. This is really important. People talk about, oh, well, I'm saving enough and I'm getting a great rate of return, but have you figured out how much money retirement is going to cost you? You know, that's really important because people when I talk to them, they really don't understand what they're going to do in retirement yet. Some people got it very, very focused. They know exactly, and it's easy to plan, and we work out the numbers. But if you don't really know what you're going to do in retirement yet, that's okay. But you have to expect to say, what do you think is a reasonable amount of money? In my last session, I talked about the average person spends about $52,000. Average couple actually spends about $52,000 or $69,000 of pre-tax income. And I talked about, if you don't have a pension plan, that's that red area on the chart here. How are you going to actually get $30,000 if you don't have a pension plan? That's you saving. It's not your company providing that to you. So it's really important that you understand these parts of your planning process: savings rate, rate of return, risk, taxes, and especially how much money you're going to spend at retirement. So I said before in the last session, these are, if you take money early, and I was explaining to you how much CPP and OAS, that's the gray areas, and the red would be your typical pension plan, and the green is your own personal assets. What I talked about was, how are you going to reproduce that? How are you going to find $37,000 of your own money to use at retirement? This is really important. So how do you know you're saving enough? Here's something that you can use. If anybody wants this, you just email me. I'd be happy to share it and send it to you. It's just a kind of like a real quick, it's not a rule of thumb, but it's a quick way for you to calculate, am I on track? So, and by the way, this is not the only tool you use. I encourage you to work with a financial advisor to actually nail down, using a written financial plan, how much money you're going to need in retirement. So look at this. If, let's say you're 40 years of age, so you look at the left-hand side, current age, take that, and then you move across to the amount of money that you're making annually. So let's say a 40-year-old is making $100,000. That's that orange bar at the top. So move where across the page where the line for 40 and the area for 100,000 intersect. That's 2.2. Multiply those two, and that's where you see the examples are written below. A 40-year-old making $100,000 should have saved $220,000 in savings right now. So this is a really quick way for you to say, am I at an amount where this amount of money, given that how much I'm continuing to save, will produce enough assets at retirement for me to be able to use that to draw and create an income. Effectively, that 37,000 plus your CPP and OAS, and there's your magic number of 50,000. Okay. Now, what if you're behind schedule? And I say to people, it's really important for you not just to simply say, well, I've got an income and I'm saving 5,000, and that's what I did last year. I'm putting 20,000. That's what I did last year. It's really important that you understand what are your current expenses and how much money you're putting away for your retirement. I really want to emphasize this because it's so important. The people that do well in retirement were really disciplined and focused about keeping their, we'll say, incidental expenses, going to Starbucks, these easy things for you to pick up on the way to work, and you're driving and you're getting a coffee and a bagel, whatever, and those things add up. $5 a day is $150 a month. So it really does add up. So what I want to share with you is a simple thing for you to keep in mind. One is, you have to try to reduce your expenses. And I don't say that you need to be wealthy by reducing your lifestyle, like retracting your life into something that is really not enjoyable. I'm not talking about that. What I'm trying to say to you is really pay attention to the small things that you spend money on, because it's so easy for you to subscribe to something that's only $9 a month, and you do it again and again and again. All of a sudden, you're at $500 a month in these kinds of expenses, and you don't see it. It surprises you. So what I want you to see is what happens with an additional $5,000 of savings a year. So you're saying, wait a minute, 5,000. What I want you to focus on is not saving more, because if you're already doing that, I don't want you to go further into, okay, we're going to eat pasta every night. What I want you to focus now on is what you do from 6 o'clock until 10 o'clock every night. Is there a way for you to generate $5,000 a year? Not 20,000, not 30,000. That's another career. But what I'm trying to say to you is, if you could generate an extra $5,000, okay, what does that do? If you can put $5,000 away, so a 45-year-old puts $5,000 away and gets 6% on your money, and then retire and you have a 5% rate of return. So we're not talking about swinging for the fence and rates of return. That $5,000 from 45 to age 65 turns into $184,000. That provides you an additional $13,000 of income. So I'm using an RSP calculator here, so it gives you an idea of what is the power of $5,000. And I'm not even talking about reinvesting the extra that you're going to get back on your return back into an RSP or a tax-free savings account. I'm not even talking about that. I'm just simply saying deposit amount, okay? $5,000 gets you nearly $200,000 in retirement. And so for many people, you think about that, that's about 4 years of income that you would have used in your normal retirement, right? $50,000 a year. This is so powerful. So how can you, so your task really for the next, 6 months or every year is, how can you figure out how to save $5,000? I tell this to my clients all the time. Is there a way for you to save $5,000, even $10,000? Is there a way for you to generate another $5,000 every year? Get in the garage, figure out what you haven't used in years and you probably won't use, and sell it. All kinds of things that you could sell, on, whether it's on Kijiji or it's hard to have a yard sale now, but you can sell these things and get rid of the stuff that's in your house that you're not using. Then find other ways to make an additional $5,000. Figure it out, because if you can put an extra 5, you've got an extra 200,000 almost in your RRSP. Guys, this is it. I've got nothing else for you today because I wanted to keep it very short. If you have any questions, please put your comments in here. I have one from Cardine. Would love to get a copy of the savings status. Cardine, just go ahead and send me an email and I'll go ahead and fire that back to you right away. I'll give you both the Excel spreadsheet so you can add in your own logo if you want to keep it for yourself. This has been, again, a very simple thing to go over because clients ask me all the time, where do we begin? How do we save more money? And this is something that everybody can do. And again, it's just one tiny little thing that you do in your overall planning with your advisor, trying to these little things add up. I always say these little things matter. And so these little things that you do make a difference. Hope you're having a great Wednesday. If you love what you're hearing, please share this with anybody that needs to see it. It's going to be on LinkedIn, Facebook, and YouTube. If you have any comments, put them there. If you're watching this in the replay, again, put your comments in there, or questions, because I'm going to be paying attention to the comments and I'll reply to those as well as time goes on. I look forward to seeing you next week. We have some exciting speakers coming up. We're going to be talking about individual pension plans for business owners. This is such a powerful tool. I can't wait to show it with you. And alternative saving strategies. So well done, everybody. Looking forward to seeing you next week at 11 o'clock. Have a great end of your week coming up and a good weekend, and we'll talk with you soon. Thanks very much. Bye-bye.